tax freight train is bearing down on your retirement. To protect yourself, you'll have to harness the power of zero.
Hi there, David McKnight here. Welcome to the Power of Zero show. I am the best-selling author of The Power of Zero, A Look Before You Leap, The Volatility Shield, and Tax-Free Income for Life, all of which can be bought in single copies at Amazon or wherever you buy fine books, or you can buy them in bulk at davidmcknightbooks.com. You can mix and match titles and achieve bulk discounts. If you are looking for someone to shepherd you through and around all of the pitfalls that stand between you and the 0% tax bracket, why not head over to davidmcknight.com? We're happy to hook you up with a member of our elite POZ advisor group, among the very best tax-free retirement planners in the nation, all of whom have been trained, vetted, qualified personally by me. And if you are an advisor who wants to level up your game and adopt a Power of Zero worldview, you can do so by heading over to powerofzero.com. So today we are going to be talking about whether all of these tax legislations that are sort of in the cooker right now, whether they could potentially be retroactive. In other words, could they affect taxpayers for the year 2021? If so, which of those proposals might fall under that time frame? So I know in a lot of my podcasts, I've been talking about how some of these things would take place not until 2022. Let's put that under the microscope and see which of these proposals might take place in 2022 and which could potentially take place in 2021. So before we get into the prospect of whether any of these proposals could be retroactive or go back to a certain point in the year 2021, let's do a brief summary of exactly what Biden has proposed so that we can understand the broad sweeping implications of what he's recommending to Congress. So let's go through these one by one. We know that he's talked about raising the business tax from 21 to 28% when you throw in a potential 7 to 9% state corporate income tax. That's topping out at 35%, which puts the U.S. near the top when compared to other nations in the world. So certainly planning on raising business taxes. Individual taxes, we've known that the top marginal tax rate today is 37%. He has proposed changing that to 39.6 for anybody making above and beyond $400,000 for married couples, and anybody making more than $200,000 for single couples. Don't forget that Joe Biden, and I haven't talked about this one in a while, but Joe Biden has recommended what I like to call the FICA tax donut hole. In other words, currently you pay FICA tax on a wage base up to $142,800. Okay. What Joe Biden has proposed is that between $142,800 and $400,000, that there is sort of a blackout where you don't pay those FICA taxes on that range of income. But what he has said is that for people making $400,000 or more, that FICA tax comes roaring back and goes on in perpetuity. So what are we talking about here? What would all that add up to? Well, you'd have your 39.6% highest marginal income tax bracket. You have the 12.4% for the old age survivors and disability insurance. That's basically Social Security, 12.4%. And then you have the hospital insurance component, which is currently 2.9%, would rise to 3.8% for all incomes above $250,000. So let's add all this up. 39.6, 12.4, 3.8. That's 55.8. Add a state income tax on top of that, say 5%. Now you're looking at a total tax of 60%. Of course, if you're in California or other really high tax states, that's going to approach as high as 70%. Joe Biden also wants to turn death into a taxable event. What does that mean? That means the estates of taxpayers would recognize a deemed sale of all appreciated assets they hold when they die, with a corresponding deduction allowed for federal estate tax purposes. By the way, I've got a couple of articles that I'm drawing today's podcast from. You can find those articles in the show notes. Another thing that Joe Biden has proposed, lest we forget, is that the itemized deductions for wealthy people really be blunted. What do I mean by that? Well, he's basically proposed that the tax benefit for itemizing deductions be limited at 28%, for people who make more than $400,000. Again, if you're making less than $400,000, it's not so much of a duck and cover scenario. But if you make more than $400,000, you will find that the IRS's crosshairs is trained squarely upon you, squarely upon your retirement account, squarely upon your ability to earn income. So even if your marginal tax bracket is much higher, you'd only have the ability to deduct up to 28%. So a lot of times throughout history, what Congress does is they either raise taxes, reduce exemptions, or some combination of the two. So this looks like a scenario where it's going to be a combination of those two things. All right. We're really just getting started here in reviewing what these tax changes are going to be. It really does sort of take your breath away when you consider the scope of what he has proposed, when you put them in sort of a punch list like this. Long-term capital gains. They would tax long-term capital gains and qualified dividends at the ordinary income tax rate of 39.6 on anybody making more than $1 million of income. Okay, so you'd have a net investment income tax. That's your Obamacare surcharge of 3.8% on top of that. And if you are in a state that charges you for capital gains taxes, like California, where it's 13.3, that's going to put your effective capital gains tax rate at over 50%. He's talked about limiting 1031 exchanges to $1 million of gain per year per taxpayer. Let's talk briefly about estate tax exemptions. He's talking about reducing the estate tax exemption from $11.7 million per person to $3.5 million, or for the credit for couples would fall from $23.4 million to $7 million. And he would also reduce the lifetime gift tax exemption to $1 million and decouple it from the estate tax exemption. And finally, he has proposed increasing the estate tax rate on some of these larger estates from 40% to 45%. So really, you can sort of sense that Joe Biden to finance, and keep in mind what he is proposing is simply an effort to raise money to pay for his spending initiatives. And I'm not here to argue the merit of his spending initiatives. I'm simply here to argue the financial viability of those spending initiatives. So what he's really proposing, the revenue raised from these taxes, he's really earmarking this cash flow to pay for all of the spending initiatives that he has suggested. And we will find out soon enough whether these things will go through. Like I said in my podcast last week, you've got a $1 trillion infrastructure package, and then I got a $3.5 trillion human infrastructure package, which includes all sorts of beefing up of the safety nets. So the question is, if we're the Titanic and we're heading towards the iceberg, when is this iceberg going to hit? And the question is, if enacted, will it be effective January 1st, 2022, or will there be some retroactivity to it? Well, according to the Wall Street Journal, and this is an article published back in May of 2021, and I'll put the article in the show notes. The Wall Street Journal published an article revealing that the Biden administration intends to increase the federal capital gains tax to that 43.4%. That's the 39.6 plus the 3.8. And that would be retroactive to April 28th, 2021. And one of the reasons why they do that is because a lot of times when they announce a capital gains tax before the end of the year, people have time to plan for it. And so the effect of the raise in the capital gains tax rate is effectively blunted. And so what they want to do is they don't want to give people the ability to plan for it. So what they've effectively done is said, this will be retroactive to April 28th, 2021. So the question is, can they do that? Is there historical precedent for them having done this? And the answer is yes. Not only is there historical precedent, but the Supreme Court has upheld this idea that a tax can be levied in a retroactive way during that tax year. So in 1993, the Clinton administration signed a dramatic increase on income taxes from 31 to 39.6 for individual taxpayers. They did that on August 3rd, 1993. And then the U.S. Supreme Court later came in and upheld this idea that the tax meter started running for the tax year of 1993 on January 1st. So the question is, which of all these taxes that have been proposed are going to be retroactive, and which will be effective, when the legislation comes out or in the new tax year 2022? What we know is that the only thing that the Biden administration has hinted at so far is that long-term federal capital gains tax rate would be retroactive to April 28th. That's the only thing that they've said so far. But you have to also know that there is historical precedent for them enacting an income tax increase during that tax year for that tax year, relatively late in the tax year. So remember, 1993, they signed the dramatic increase on taxes from 31 to 39.6. They did that on August 3rd. They made it retroactive to January 1st, and the Supreme Court upheld it. And if you believe in stare decisis, then they will probably use that as some precedent to sort of interpret how this would be dealt with moving forward. So where does this leave us? This leaves us in a position where we don't know if any of the tax rates we've discussed today, whether they're going to be going up this year or in the next year. We right now are in the throes of a scenario where Joe Biden is perceived to have not acted judiciously when it comes to the withdrawal from Afghanistan. So perhaps maybe he's lost some political capital, and perhaps maybe he won't have the same backing for all of these different proposals. My sense is that he still has it. So stay tuned, of course, to this podcast. We will keep you posted on everything. I think the big takeaway from this podcast today is that if that tax proposal goes through, that tax legislation goes through, that the long-term capital gains on wealthy people will most likely be retroactive to April 28th. Remains to be seen on all of these other issues. All right. Once again, if you're looking for help to navigate all of this, head on over to davemcknight.com. We'll hook you up with a member of our elite POZ advisor group. If you're an advisor, head over to powerofzero.com. You can opt into a free 3-part video series on how to transition your practice to a Power of Zero style practice. And of course, would love a follow on Twitter. It's at McKnight & Co., at McKnight & Co. And if you can also follow me on Instagram, if that is your social media platform of choice. It's David C. McKnight, David C. McKnight. Thanks, everybody, for being with me this week. We will look forward to chatting with you same time next week.